Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, family office network based in Greenwich, Connecticut. What happens when you apply neural networks to 40 years of proprietary investment data? At Russell Investments, Kate El-Hillow is finding out. By bringing AI into the heart of manager research, El-Hillow is moving beyond human intuition to pressure test the world's best investors through million trade simulations. We spoke to Kate about how AI is transforming the way Russell selects managers, filters the global information firehose, and modernizes operations at a legacy firm. We also talk about the complexity of the OCIO business, filtering talent, Kate's litmus test for managers, and how last year's shifts in global policy will affect everyone's portfolios. Kate El-Hillow is President and Chief Investment Officer of Russell Investments, overseeing asset management, implementation, and research to deliver client investment solutions. Based in New York, she also serves on the firm's executive committee and chairs its operating committee. She joined Russell in 2021 and brings over 25 years of investment management experience with deep expertise in OCIO and multi-asset portfolio management. Previously, she was Deputy CIO of Multi-Asset Solutions at Goldman Sachs Asset Management and held senior investment roles at JPMorgan Chase. In 2024, she was named one of Pension and Investment's most influential women in institutional investing. Please enjoy my conversation with Kate El-Hillow.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
So you always wanted to be an accountant. Tell us about that. Growing up.
I'll link that back to my dad, who's amazing and has guided me through my career in lots of different ways. But I actually wanted to be an interior architecture or designer, and my dad's like, "How about accounting? Why don't you try accounting?" And in hindsight, it was brilliant because the financial industry is amazing in terms of exposure you get and the type of things you learn. But as an 18-year-old, it wasn't my dream job for sure. But you never know.
Yeah, but what changed your mind?
I started out in the city with JPMorgan back in the late 90s, and I think there's a couple things the excitement of it, the pace of it, just understanding more about how the world works through the eyes of finance and economics and the markets was just very eye-opening. And I had the benefit of doing it like in New York, London, and Tokyo with JPMorgan in the first 5 years of my working. And so just such an experience, both personally and professionally, to really put yourself out of your comfort zone and just learn a lot and learn about the world. And I think that I started out a bit more on the risk side of the equation, working a lot more with the trading businesses. And that is, as we all know, is fast-paced, it's exciting, it can really teach you about risk and how to manage it. And I was in Japan during the Asian credit crisis where spreads were blowing out and really learning about what it meant in terms of credit risk and how to manage it. It was very eye-opening for me and it was very exciting, but I didn't love the transactional nature of it. And so when you say, why do I love it now? A lot of it was because of the shift that I made more onto the asset management side about 5 years into me being in finance. And there, what drew me to it was it's client focused in a different way, in that it's much longer term focused. It's more strategic than maybe the trading and risk side of finance, and was really about solving problems. And ultimately, a lot of what I've done is around retirement solutions and really thinking about financial security. And all that just started to come together in terms of where I could see myself being for my career.
But what was it specifically about the investing piece that you liked, and obviously not the trading side?
I think it's about the constant curiosity and trying to learn about investments, different types of asset classes, different types of ways to combine asset classes, managers, in many cases through most of my career, to develop a portfolio that achieve certain objectives for clients. But I think it's the constant learning and just me just being very curious and loving to understand more about the markets and different industries and how just like global trade works and everything comes together. That to me is just every day I come into the office and there's something else that I can learn, analyze, understand more about my clients, about the portfolios, and honestly about the world and how it all works and fits together. And so it just makes it very easy to do it for decades when you're constantly learning and challenging yourself.
Do you think there's anything you learned from interior design that helps you in portfolio construction?
Yeah, I think it's how does it all come together? Like designing a portfolio has elements of thinking about where do I spend the money and what's going to have the most impact, and do I really need that feature in the portfolio. We run a platform that is completely open architecture at Russell, so I have access to every asset class, pretty much every manager or instrument that one could have. It's a full ecosystem, and that's amazing, but you need to have a really good filter so you don't overcomplicate things and you really think through what is necessary to build this portfolio. So I think there is some relation to if you're trying to design a house and you have a certain outcome you're trying to achieve and a cost that you're trying to manage, to be balanced about thinking through, like, is this really going to have the impact or effect that I want it to have?
But you don't have to deal with contractors.
Yeah, exactly.
So you did mention that you were in Japan during the Asian financial crisis, which I'm sure must have been fascinating. For our younger listeners, could you maybe describe what that was like?
I was early 20s and had been out of the country living in Europe during college, but never to Asia. And I would say one thing was interesting. It was the first time I really felt like a minority. I was in a country where I was very different than the broad population, and I thought it would be uncomfortable, and actually it was very welcoming. People were very interested in engaging, meeting, and it forces you to think differently about how you're interacting with people. You want to be very conscious of the culture that you're entering into. You want to be very respectful. This is in the late 90s too. It's not like we had internet and all sorts of things to teach you about these companies. I got a little book and a cheat sheet on things to do and don't do when moving to Japan, and it makes you nervous, like how you handle the cards when you're receiving them from a client, and so you learn a lot about the dynamics of working with people from different cultures, and that was extremely exciting. I was there during the Nagano Olympics. I did a lot of exploring around Japan while I was there, but I'd say the thing that was most formative, I just say from a personal and from investing perspective, was seeing the amount of stress that was being created in the market as the credit crisis unfolded. And I was working more on the risk side, but with the credit trading desk, and the spreads just kept on blowing out. And you're watching a trader really try to think through, how do I run this matched book that I'm supposed to be at the end of every day being basically neutral on risk, and was really struggling to get there. And it just taught me so much about risk management and the markets, but also human behavior during kind of those periods, and being able to absorb stress and manage it versus some people maybe didn't handle it quite as well. So yeah, between being in the Japan, new country for me, I didn't speak any Japanese when I went over. I was working for an American company, so that made it much, much easier. But then in a period where everybody was at heightened stress levels because there was so much going on in the markets, and it really just threw me into the deep end of the pool in terms of making sure I was asking the right questions, not wasting people's time, because I was still pretty junior, thinking through how can I have impact here while still making sure that I'm not creating extra stress on this group of people that are trying to manage this money. Ultimately, I think my time there made me probably think about the global investing market in a way that I don't think I would have done as early in my career if I hadn't lived abroad in my early 20s. I think it's sometimes if you're in the United States and you have such an innovative market, which is such the cornerstone of growth in capitalism, you sometimes wonder, do I really need to go outside of the U.S. in order to really get growth and develop portfolios? And when you start to see different economies, different sectors, different markets, you're early on in your career, I think it just opens your mind to say, okay, what else is out there?
So speaking of different cultures, you worked at JP Morgan and Goldman.
Yeah.
How would you compare and contrast them, the cultures and your experience there?
Yeah.
And maybe how do those different cultures help you in your work?
So I joined JP Morgan when I'd say it was still a small company. So it was still under 10,000 people. It was in the late 90s before a lot of the acquisitions happened. And when I joined Goldman, it was also about a similar size. And I think what I'd say is there were lots of similarities to, and one of the reasons that probably I left JP Morgan, it had gotten so large. It was 250,000 people by the time that I had left. And I think from a client-focused perspective, intensity of the people, and I'd say just the way that the teamwork, I'd say, came together at both firms, I'd say actually was pretty similar. What I'd say was most different about Goldman, and this has been interesting as I've moved on from Russell, was the commercial focus on being competitive with the outside world, but not with each other, and really thinking through where's the market growing, what are the key drivers, who are our competitors outside, how can we make sure that we're winning more than our fair share. There just was an element of being more commercial at Goldman that I hadn't experienced, I'd say, the same way at JP Morgan. And I actually think that's pretty healthy to always be looking outside to understand what other ideas seem to be taking hold on the market. And if we are losing business, why are we losing business? And really thinking about it in a healthy way, okay, how can we make ourselves better and trying to innovate. And I feel like that kind of mindset or culture was much more pronounced at Goldman than maybe what I had seen at JP Morgan back in the day.
What kind of work were you doing at GSAM?
Basically what I do now. So I'd say that most of what I've done for the last 25 years is developing portfolios using a broad set of managers and strategies that were both internal and external to Goldman. And so it was this multi-asset or solutions business, or some version of that. They were called different things over the years. And we would work with large institutional clients, and often they would outsource their total portfolios to us. And we would help them design their asset allocation, think through the level of risk they want to be taking, any type of liquidity considerations that we need to take into account. And then we would think through what types of strategies or asset classes you would allocate to in order to deliver that portfolio ultimately for clients. And I basically was part of the team that built out that solutions business that now is their OCIO business at Goldman.
Did you spend a lot of time in manager meetings?
I did in the early days, yes. And it's such a wonderful way to enter asset management, like having the benefit of talking to some of the best investors in the world and question them on their philosophy, their process, how they're thinking about the markets, what their outlook is, but then really digging into their portfolios and the decisions that they're making. And it's a gift, like, to be able to do that. And the types of personalities that you get to interact with, like, when you do that, it's to be an investor and to take that type of risk and have the confidence and conviction to do that, but do that in a way that is still very balanced, is hard to identify. And I think when I go into these manager meetings, it's trying to find that balance of somebody that is extremely convicted in the way they think about investing and allocating capital, but also somebody that is balanced and humble enough to know that the markets can do unexpected things, and like, how do you react to that? And yeah, I spent a lot of time in manager meetings across public and private markets over the years. And we talk a lot about data these days, and everybody has access to data and more information and data. That doesn't necessarily make you a better investor. It's how you take in that data. It's how you make judgments around what's noise versus what's real information. It's how you size those positions within portfolios. That is really the skill that is, I think, harder to, one, analyze and quantify, but is the thing that you're ultimately looking for when you're spending time with managers.
Did you have any particular mentors along the way, or was there any particular style of investing?
I have the benefit of meeting so many different types of investors, and the type of investing that I typically have done is more around, I'd say, portfolio construction, combining those managers and strategies in a way that helps deliver on a particular outcome. And so a lot of my grounding, and this would be from the GSAM days, was around like risk budgeting and thinking about, like the allocation of risk, and is the portfolio balanced, and do I have any concentration risk that's not intended, and how to identify that. And so I'd say a lot of the influence that I have, that I think has taken me through most of my career, has started from a strong sense of risk in the portfolio and risk budgeting, and having good discipline around that. And I think that's always a good anchor point to have. I think what I've learned more and more over the years, and this is both seeing the managers that I allocate to, but also the experience that I've had as we're managing money in different types of market environments. It's good to have that anchor and have that discipline, but it's like the judgment in terms of when you need to make shifts within the portfolio, when the market is maybe acting and reacting in a way that might be less expected, that requires maybe a little bit more art than maybe the science of risk budgeting and some of the things that I grew up thinking was the way that you think about allocating capital. So that definitely has influenced me a lot. Like Bob Litterman was very present when I joined Goldman, and a lot of the thinking, the things that drove how we built our portfolios came from a lot of the work he did around risk budgeting. So that's been formative for me, for sure.
Was that an evolution at the firm? What had they been doing before that?
No, I think it was core to GSAM, and I think it's grown in magnitudes like since I've left there, but I think that was a core to, particularly when you think about constructing portfolios, you have to have a framework for doing that at least anchors you. And risk is something that you can measure and manage more so than returns. Like, you can forecast returns and have some expectations around it, but risk was something there's different ways for you to create models and frameworks to help manage the portfolio. So I do think that's a good underlying framework that many investors now adopt that maybe didn't take 20 years ago.
If you were going to hire a CIO, what would you look for?
It depends on the investment organization that you're hiring them into. But if I'd say, I think every CIO should have a strong sense of talent and people, both identifying good investors and developing them. I think that is critical. It's something that I know it's actually quite hard to do. It's something I enjoy in my job, is really finding people that have the right intellectual capability to do the investment role and understand the process. You have alignment in terms of philosophy, but really understand how to manage risk and manage portfolios. But identifying that talent, I think, is key as a CIO. The other thing that has, I think, gotten more and more important is a really strong understanding of data and technology as a CIO, I think is becoming more and more important. I think it's both for efficiency reasons, as you think about how do you manage your process and the day-to-day kind of risk in the portfolio. But increasingly, I think it's going to be around idea generation and how you continue to innovate your investment process. Having a strong understanding of data and technology and how to integrate it into the process is going to be more and more important. So I'd say those are the two core things, no matter what kind of organization you're hiring into, I think is important for the CIO to have. For Russell, the seats that I've been in, I wouldn't underestimate how important it is to have a broad understanding of the types of asset classes that you have access to when you're developing portfolios. And it kind of goes back to what I said before, having the right filter and understanding as to which asset classes or which strategies can really help you achieve your goal. I had one of the risk officers at Goldman back in the day. We were creating an income portfolio, and we had a lot of lines, a lot of different asset classes that we were allocating into in this portfolio. And we spent months and months thinking through what was the best way to create like a multi-asset income focused portfolio. And he asked like the simplest question. He's like, what are the 5 most important asset classes in this portfolio? You got a lot going on here. What are the 5 most important ones? And it just forced us to step back and think through like, which are the ones that are really going to help drive the results for this fund? And let's make sure we get those right. And then the other stuff, filtering around it can help in certain market environments or certain types of regimes. And I think that a CIO needs to really have a good grasp of the outcome that you're looking to achieve and what are the key risks or asset classes or strategies you need to do that. And you try to deliver in the simplest way possible. And I think that's a skill that you can develop over the years, but I think is more and more important as we shift more from product-focused asset management to more solutions-focused asset management.
That's a very timely topic. The investment toolkit has expanded dramatically even since then.
Yeah.
Investors now have access to a wide range of asset classes, strategies, structures. Curiously, though, that's made diversification somewhat more complicated. Yeah. What are your thoughts on that?
The first thing to say diversification, the stock bond relationship correlations have not operated as well in the last 5 years versus the last 40 years. And so I think that's made everybody step back and say, okay, diversification, what's the measure of it within the portfolio? Do I have true diversification? Yes, I'm thinking through building the portfolio. And just having lots more line items maybe gives people comfort, but it doesn't necessarily, depending on the market environment that you're in, protect the portfolio. I think more and more diversification is going to be linking to being a little bit more dynamic and related to the environment that you're in, and what are the types of asset classes that are going to do well in particular type of like structural environments that we're operating. So if 5 years ago growth was more of the focus, and now you've got growth and inflation and other macro factors you need to think about, how you create a diversified portfolio might be different than what we might have said 5 years ago. And having this broad set of asset classes to choose from and being able to figure out what is the right diversification measure, and do I think it's going to be reliable throughout the market cycle. But there's a lot more discussion and debate that we're having on that. If you add into the mix, there's a lot more data and ways, I guess I'd say, to pull together what managers are doing, what the markets are doing, what we're seeing in terms of macro factors within the economy, being able to bring that all together to find different ways to measure the risk in the portfolio and the level of diversification that you have, not just rely maybe on correlation assumptions or long-term risk assumptions to do that for you, but really find other ways to measure the diversification in the portfolio is going to be more important. You're looking at different patterns in terms of how asset classes or strategies react in different types of market environments or market shocks, and starting to say, okay, it's in these types of environments that these strategies will tend to do better. Let me pair it with, so they take trend as an example. There's certain periods where trend can take the behavioral element out of getting in and out of the market at the wrong time. You just follow the trend. But if the market moves quickly, trend won't do well, right? The trend changes and trend won't do well. Pairing that maybe with a volatility-oriented strategy that's good when volatility spikes could be a good combination. So really starting to think through the types of strategies that you can pair together that complement each other in different type of market events. And that's the benefit of the bigger toolkit and trying to figure out how do you use it and can I size it in the portfolio in a way that's going to have enough impact while still keeping the core tenets of having a good chunk of equities in the portfolio, credit and term premia driving a majority of the risk in the portfolio.
So I haven't even asked you about Russell itself.
Yeah.
The firm is an institution in its own right. How big is the firm now? What are the major divisions? What are the major efforts?
Russell, we're in our 90th year as a company. We started out in Seattle. The company's still headquartered out in Seattle. We have 1,600 people globally. We're in 15 different countries. We operate in about 30 different countries. $375 billion in assets under management. And the core of what makes, I'd say, Russell pretty unique is that we have like open architectures at the center of how we think about designing and delivering portfolios for clients, meaning there's no one manager that's great at everything. And so having access to managers across public and private markets, active, passive, systematic, fundamental, and being able to select from them to develop a portfolio, we think is core. Yeah, to basically developing a good long-term portfolio for a client. We pair that with implementation, and an implementation platform that is very differentiated in that it was built in a really integrated way to help better manage exposure and risk for clients' total portfolios. And those two things together, that open architecture, but with an implementation platform that helps really, I say, round out the edges and bring the portfolio together is what's pretty unique about Russell. And we deliver that both to institutional and retail clients. We have about 3/4 of our assets are with institutional clients across the globe, pensions, endowments and foundations, hospital systems, sovereign wealth funds. And then 25% is more in the retail market where we deliver model portfolios to advisors through different type of financial platforms. So the common thing across most of our portfolios is we tend to create total solutions for clients at the core of what we do, again, using that open architecture and the implementation capabilities.
Could you tell us a little bit about the president's role at Russell?
I joined Russell as the CIO and became president about 1.5 years into that role. And I think similar to other firms, like the president role is to really think about execution of strategy and making sure we're operating the business efficiently and really aligned with our growth goals that we're trying to achieve. And pairing that with the investment EOC might be a little bit unique, but I think in the solutions-based business that Russell runs, where we're not necessarily developing products from an investment perspective, we tend to develop portfolios or solutions for clients. It's really integrated in a way that's different, I guess I'd say, than other organizations that I've been in. And so having this president seat where I'm working extraordinarily closely with the investment team, the product team, all the technology and operation teams, and trying to bring that together to deliver the portfolios to clients ends up being a pretty natural way to divide up my day. But at the highest level, it's really focusing on the internal management of the business and helping us drive our strategy and our growth.
Tell us more about the OCIO business. How fast is that area growing? What sort of clients are you talking to? You just mentioned some, but...
Yeah, OCIO continues to be a growing area within the asset management world. It had been heavily pension weighted for many years. You think about corporate pensions, typically it's not their core business. They're industrials, they're different types of telecommunication, different types of companies have a pension or defined contribution plan inside their firm, but they're not experts at finance. And so it's very natural for corporations to say, maybe I should actually outsource this. And so pensions have been outsourcing to providers for decades now. Endowments and foundations, where you often will have a smaller, sophisticated team in-house, and it is their core job to manage the money, it wasn't necessarily outsourcing as much, maybe until the last 10 years or so. And I think a lot of the reason you started to see endowments and foundations start to outsource was because there was a cost benefit to it potentially. There might have been something around governance and complexity of the investment solution was starting to be a little harder to deliver with a smaller team. And they just needed some other services or capabilities that they didn't want to build out in-house, and so they started to outsource parts of their portfolio. Hospital systems is an interesting one where they're really a complicated, probably one of the more complicated institutional asset owners in that they'll have an operating pool that will support various types of requirements of the hospital system. They'll have a pension for the workers, and then often they'll have some sort of foundation alongside that. So you have multiple pools of assets with very different objectives that you're trying to achieve in an organization or ecosystem that's really focused on health and medical benefits. They're not necessarily financial focused organization. And so again, there you tend to have very small but very sophisticated teams trying to deliver a pretty complicated investment solution across the enterprise. And they started to see the benefit from a risk management perspective and just having a partner to basically extend their capabilities and be, I just say, an extension of their team from a big perspective, helping them think through analyzing different ways to think about the risk profile of their operating pool. How do I get more liquidity in the portfolio without necessarily impacting the return as much? And so hospital systems have started to outsource more and more.
Do they have big teams? Have they been doing this on their own?
They tend to have, what I would say, are small but sophisticated teams. Like I would say 10, maybe 20 when you start to take into account some of the administration and operational things that are required. But they tend to be smaller teams, even though it's a very complicated investment program that they're looking to run.
And how much of the operating budgets are they funding?
Yeah, it's shifted a lot. If you think post-COVID and some of the challenges hospital systems were having, whereas prior to that, the long-term pool of assets was really about growth and funding long-term plans and projects was really the focus. There's much more pressure for the operating pool to be there as more than a backstop for the hospital system's general operating needs. And so shorter-term pools of assets started to be created to help manage some of the needs they had to just manage whether it was a slowdown in activity or an increase in cost. And so it's really started to shift. So you can end up having 30-40% of the assets be more in short-term pools or medium-term pools that are really helping support the operating portion of the hospital, and then the long-term pool that's more for the long-term kind of stability and growth.
What are these engagements like? You're coming in there, it's often uneven, you're coming in the middle of the movie.
Yeah.
What's the first thing you have to do? Do you have to get the governance straight? Do you have to figure out where all the assets are?
I think the first thing is to have really deep and candid discussions with the client on where they see some of their biggest opportunities or challenges, and putting some structure around that. You're starting maybe with governance, but then really thinking through whether it's liquidity challenges they're having or certain return or growth expectations that they need to be meeting that they might be struggling with. But really, it starts out with a good conversation, and there's lots of them, around what are your key objectives, where are you struggling, and what are the problems you're trying to solve most urgently. And it's different for every client that you go into. They all have different needs because you're coming in the middle of the movie. And so that's one of the benefits of at least how Russell is set up, is that we're pretty flexible in terms of how you can build an outsourced relationship or partnership with us, and you can focus on the pieces of the portfolio that might need the most help most quickly, and then build in to a broader solution over time.
Any advice for folks working on governance issues, how to work with boards?
I think having good frameworks and structure is important. You have to start, like setting the expectation on what decisions are the most important decisions that the board should be weighing in on, and making sure that there's good information and data around that looks similar, if not the same, every time they're looking at it. Balancing those two things out, I think, is probably one of the most important things. It's very easy to get these sophisticated boards that have come from different walks of life and have really interesting and strong perspective on finances or particular problems, maybe whatever, whether it's a pension or a hospital system that they're going through. And you can get down rabbit holes pretty quickly if you don't manage, I'd say, the conversation and the focus. And so I do think it ends up being around making sure you have the structure around what are the principal decisions that we need you to be weighing in on, and then making sure you have the right information for them to be able to oversee and kind of help make those decisions.
Where does governance go awry, in your opinion?
When you go off what are the core decisions that you need to be making, or you end up having a risk that might be new to the constituents and have not be as educated on it as they need to be. I think in hindsight, when things start to go awry, it comes back down to you probably didn't have the right conversation to get the right information to the decision makers to help frame the discussion. And so I think that is most often it's around education and really making sure that there's like that good information to help frame the discussion and make the decision.
Where do Russell's clients come from? Is this all organic?
It is, actually. And this is one of the interesting things, being a privately owned standalone company. We don't have some of the natural entry points into corporations or different types of companies that maybe some of our competitors do. And so a lot of it is just through like organic kind of sales growth or clients referring other clients, to people in their ecosystem.
You mentioned the firm's been through a major transformation. What's been happening?
I'd start first with, and I'd say I joined almost 5 years ago now, Russell, and the platform that Russell has created, again, that open architecture with the implementation capabilities, was absolutely amazing. But it was quite focused, maybe a little bit too narrowly, on certain types of clients and certain types of solutions. And so the shift that we've made over the past 5 years, I think first and foremost is in the big growth areas that we have around like OCIO, our retail and wealth business, and even in our implementation business, just executing better on identifying the problems with clients and helping drive towards getting to an answer or solution with them, and being a little bit more market aware, like with what was happening. What are the issues people are dealing with in their day-to-day dynamic? What problem do they need to solve? Whether that is currency issues in Japan or it's liquidity issues with hospital systems in the US, but being very client-focused in terms of how we're thinking about going to market. The second thing I'd say, we talk a lot about outsourcing because it's so core to our business, but not every client wants to outsource everything. Like they may have pieces of things that they want to outsource. And so part of what we did is say, okay, we're going after clients that want to do a full outsourcing, but there's lots of clients that could tap into our implementation platform or parts of our asset management platform to just do pieces of things that they can't do in-house or don't want to do in-house anymore. Let's really think through like how we can broaden out the types of clients that we're working with and not just focus on the full outsourcing. Alongside that, working more with financial institutions has been a bigger shift over the last 5 years. So think insurance companies, asset managers, and wealth platforms. We didn't do as much with financial institutions previously. It was a lot with corporates and endowments and foundations and hospitals, more asset owners. So the financial institutions piece was a bit of a new thing for us to do. And the third thing is, and it goes back to looking out into the broader market and looking to see what advisors you're doing and how they're wanting to access the market. Our retail and wealth business was very mutual fund heavy and focused. And a lot of the advisors these days, want ETFs or they want to have access to alternatives. And so there's been a big effort in the last 5 years to modernize our retail and wealth platform and how we're delivering models to clients. And we had all this stuff in-house for the most part. We just hadn't packaged it yet in the way that advisors want to buy now and how they want to be able to access the market. And so we've done a lot of work to launch active ETFs that are multi-manager. We're in the process of launching interval funds to better access alternative asset classes for advisors. And then one of the great things that Russell has, we do direct indexing, which is lots of people do that, where you're getting kind of that separate account feeling in terms of accessing the equity markets. But we do it in a much more tax efficient way. And we help advisors basically transition client portfolios from where they are right now to where they want to go in a tax optimized fashion.
How has AI improved your research?
When you are the first to do something in the market, and Russell pretty much is the first person to manage your research, and you've done it for 40 plus years, it's hard to, you incrementally improve things every year. You refine things, but every once in a while there might be an inflection point. And I absolutely know that we're in the middle of that right now. We've, over the last 40 years, have built out an amazing data set of exposures, presentations, meeting notes, videos, and things like that of the managers that we invest in. We had this amazingly rich data set. And there's no way a human can take in all that information naturally. You can try to stay on top, but we cover 16,000 managers, whittle it down to maybe 700 that we rate and then monitor, and then invest in about 300 on the public side. So like, you think about the vast amount of information and data you have.
Is that a smaller number now than it has been?
It actually is, and that's conviction-led. We basically said, let's focus on the managers that we think have the highest impact, and we've gotten that list down a lot more in terms of the ones we actually invest in. And whether it was a great decision on my part to put our new head of research into her seat, Evgenia Grzdeva, she's a PhD. She worked in our systematic quant investing research team for many years. And I put her as head of global research across macro manager research as well as the quant research a couple years ago. She's a PhD in neural networks, so has a strong background in AI-related concepts, but always knew when she did it 20 years ago that the compute power wasn't there. And over the last couple of years, that's shifted, right, alongside some tools out there to help be able to really change how we're using data and integrating it into investment processes. And she, in this short period of time, has really helped mobilize both the investment team and the technology team to take all that data set that we have in terms of manager information and research and use different types of AI tools to both find the managers that we think are going to be great, and then once we found them, really be able to monitor them to make sure they're doing what we think they should be doing. And I'd say that we're in very early innings of, I think, the impact that we can have using AI to really help improve our decision making and our sourcing of manager ideas. But the pace at which we're moving to make improvements is staggering. And I think it's just this idea, the things that would have taken years previously to build out in terms of research projects are taking us months to get done. And so I think that the impact that AI is going to have, particularly when you've got domain expertise and unique data sets, is going to be pretty transformative. And for us, that's manager research and data. And we're on our way, very focused on the manager research side. but it's also going to start to impact how we're constructing portfolios.
What kind of insights are you surfacing from looking at these managers? What's helpful that wasn't there before?
It's not like it wasn't there before. We have seasoned researchers that think through these things, but being able to test these things more objectively and at scale is one of the first big differences. But I'll just give you an example. The managers we look at, I'll just focus on equities, you expect that they're going to be good stock pickers. And so you test that, you have attribution, you look at them over time, and do they deliver alpha? Are they good? Is that a good skill set they have? And we found that most of the managers we've selected are good at selecting the stocks. In terms of constructing the portfolio, thinking how to weight those stocks, there was a little bit more dispersion in terms of who actually was good at picking the winners, right, and sizing them appropriately in the portfolio. And then the third one, this is the first project we did, so it's a good one to walk through. The third one is how are they at upsizing and downsizing those positions as well? Do they get in at the right time, and do they get out at the right time? And just being able to systematically look at that across those, at least the 700 managers. We actually did 1 million different trade scenarios across all the managers we looked at and tested. What are they good at? Selecting the stock, sizing them in the portfolio, or how they trade in and out of them. And it gives you another very, I'd say, rigorous and deep discussion, focus with a discussion with the manager around like where's their skill and what are they best at. And so it's starting to have us also think about if a manager is great at selecting the stocks, but maybe they're not as great at portfolio construction, we might take those 5 managers where 2 are good at everything and the rest are really good at stock selection, and we'll take that full set of stocks and we'll use that to build our equity portfolio with maybe a more awareness of the benchmark in mind and more awareness of overall risk in the portfolio in mind. So we're doing more of the portfolio construction and then using their stock picks to help drive the universe that we're selecting from. And so there's things like that we're doing to test out, is that a better way of accessing alpha and accessing their skill risk versus taking kind of their full package as they've designed it. And so it just is allowing us to kind of question ourselves, question like some of the managers that we thought were great at everything, maybe they're not, like what are they great at? Let's focus on that. And doing it in a more objective way.
Talent is idiosyncratic, and it's often hard to pick it out, especially in new funds. And of course, the game is always to figure out what's luck and what's talent. Is it helpful in that regard?
I think it helps you test it out a bit more and also look for patterns. If you think back 15, 20 years ago, people started to look at 13F filings to see, okay, if so-and-so that I think is an amazing manager is picking that stock, who else is picking that stock? And you tried to, without creating kind of correlation between your portfolio, you tried to look for good investors in that way. I think this is the well-advanced version of that. What are the skills that make a good manager throughout the cycle in terms of the different types of decisions that they're needing to make, and having different ways to test that is, I think, beneficial. And so I think that's like the big shift here. It's a quantitative way of maybe trying to assess the skill or the art that goes into investing. At the end of the day, I feel like I'm always still going to need a portfolio manager and a research analyst to analyze that data that's coming out of all of these models that we're building and ask the question and really pressure test it. But they're doing it in a way I think that's so much richer and, again, more rigorous than maybe what we were doing a couple years ago.
What do you think people don't understand about manager selection?
I'm not sure that people don't know. This is a pretty obvious statement, but it's one that I think we tested on ourselves. We, in addition to looking at the managers, we shine the light on ourselves. And we said, are we getting too connected to some managers where it's you meet managers, as you said, I've done this for so many years, and it's hard not to meet investors and fall in love with their strategy, and then they're very compelling. They're good storytellers. Wow, that person's brilliant, and I really bought into that story. You can get very attached to a manager and maybe hold on to it for too long. We talk about managers doing that with stocks. People can do that with managers. And so what are the signs that maybe the skill or the reason you originally selected that manager is starting to maybe decay in terms of value, or maybe their team has shifted or their focus has shifted because they've gotten bigger in terms of asset growth? And so I would say in manager selection, you've got to be as critical of yourself in terms of getting too tied to the people and the organization and making sure that you're making the right decision. So we looked really hard about, are we good at getting into the managers and are we good at getting out? We're much better at getting into the right managers versus getting out. And so we're spending a lot of time thinking through what are the flags that we might have missed that would have helped us be smarter about when to get out of that manager that just lost their touch. Or it could have been because they grew too large. It could have been because of focus. There's all different reasons that could drive that. If their strategy's out of favor, things like that. But is there a way for us to really think about how do I know when to get out of the manager? We're good at getting in. Getting out, we probably have more work to do.
So how do you know how to get out of a lagging manager?
It's rarely performance. I would say that drives, that's a lagging indicator. Like by the time performance has really gone off the cliff, you probably have missed your moment and missed the point. And so a lot of what we do is think through what were the signs. And so some of the flags could be around even like the nature of the research team and how they're working with the portfolio manager, the composition of the research team, the quality of the research team. There could be certainly things around different competing business priorities can really change the nature of the organization and the culture of the organization. So there are soft reasons and hard reasons why a manager might be starting to lose their touch. And so like the asset growth one is an easy one to check. If somebody is just taking so many assets and it's just harder for them to deploy capital, and so they start to have to find other companies or other securities that they're allocating to, those are things that are easy to test. The harder ones are going to be around kind of culture and people, or now I'd say, are they keeping up with AI developments? Are there other types of data sets or tools that they could be using, and are they progressing while still staying true to their philosophy, how they actually source ideas? And so I think there's different flags or signals that you look for. On the fixed income side, there I would say credit underwriting, so the structuring kind of skill, and some of the things around just collateral that's backing some of the securitized assets you might invest in. All of those things are key inputs to the investment process. And so you've got to go into each piece of the investment process, not just look for the results and do a little bit of attribution. You really need to understand what's driving the results and has that changed. And so I'll give you an example. And it mostly comes up when stressed environments hit, that you realize that they weren't as good at structuring as you thought they were, or they weren't as careful about really understanding the collateral and whether they really had perfected and had real linkage and ownership of that collateral that was backing that security. And so you really have to have the right research approach to think through what are the key drivers of their success and are they continuing to deliver on that. If you just focus on the higher level attribution that you often get from the risk models, you miss out on probably some of the nuanced things that really drive the risk in the portfolios.
Do you think asset allocation will eventually be automated, or do you think there's a certain art to it?
I think there's asset allocation tools and frameworks that are always going to be there just to kind of ground yourself a little bit in numbers and a little bit in kind of history as you try to forecast the future. I think a lot of it already is quite systematized in terms of how we generate initial allocations, CO4 portfolios, but it's very rare that a client invests in people's model portfolios. And the reason for that is because they've got different objectives or they have other assets that they can't sell. There's different reasons. And so I think like the nature of how to balance out risk, look at different risk factors, stress test the portfolio, all that I think is going to continue to get very systematized. But that only gets you maybe 70% of the way there in terms of really getting the right asset allocation to deliver for the client. And then ultimately, that's just the blueprint. Then you need to actually think about how am I investing that asset allocation? What strategies am I selecting? Has the market shifted from when I designed that portfolio? Do I need to make adjustments to the portfolio? And so asset allocation it's going to need to be more dynamic, is what I would say, as you think about how do I use this asset allocation as an anchor point and take all that great information that might be a little bit more systematized to get your starting point, but how do I think about adjusting away from that and thinking about it more holistically in terms of the bottoms up type of strategies that you're selecting. So maybe the simple way is I think asset allocation, I think you can have a very scientific way of coming up with the starting point, but actually implementing it and then managing that asset allocation over time is going to need to be more dynamic. And that requires a little bit more skill, judgment, and awareness of what's going on in the market outside of what a model might tell you.
Liberation Day is now perceived as a clear signal that the global macro picture is going to be a little more complicated.
Yeah.
How do you think about this reshaping of the world as we end up maybe in a more pluralistic market?
I feel like we've talked about this for certainly at least a decade. Yeah, as you have different spheres of influence starting to have more impact across the globe. But Liberation Day felt like a material enough policy-related shift that may change supply chains, globalization, a lot of the things that drove productivity and how trading partners operated is starting to shift potentially. And the first reaction that as an investment team we've had to that is diversification. From a regional perspective, from a sector perspective, is probably more important than ever, as you start to see that shift. Generally speaking, if you were in U.S. equities and treasuries over the last 15 or 20 years, that was better than a diversified portfolio. With things like Liberation Day and some of the policy shifts that are happening, where you might have some divergence in terms of both how capital is flowing, but also how economies are growing, and they're going to be maybe a little bit less integrated than they have been in the past. Having a more diversified portfolio is going to be more important in a world that starts to maybe not be quite as integrated as it was previously. Now we'll see if structurally this is going to persist over 5, 10, 20 years, and it's going to be a big structural shift. But we do think diversification is going to be one of the key elements. And so that could be, instead of just holding treasuries within your portfolio, holding a global government bond, your portfolio that might be hedged back to your base currency is going to be better, more balanced bond portfolio to hold versus just relying on treasuries to be your fixed income allocation. Certainly, we saw it last year. If you just look at that in quarter to quarter, you had Europe did excellent in Q1. Then you started at the US, came back a bit in Q2. You had Asia, more in kind of Q3, Q4 and EM, start to do better at the back half of the year. It's just interesting to start to see some of the divergence from a regional perspective and some of that broadening out. And a lot of this is because these policy shifts. And so we do think that, again, having more of that diversification and then more awareness of how things are developing structurally across the globe is going to be more and more important kind of post, I'd say, Liberation Day.
Have you seen changes already in the way your clients think about their portfolios?
I'd say that currency was probably the first place that I'd say consistently across the globe people maybe rethought how they were positioned from a hedging perspective. And so if previously being long U.S. assets, long dollar, felt like a win-win, growth assets and a hedge. Maybe there's a thought about, okay, maybe I should be a little bit more hedged to my base currency versus having so much dollar risk within my portfolio. And so that was maybe a bit of a theme that we saw coming through. I do think because portfolios generally for most clients have gotten more diversified over the past decade, and I think in the past 5 years with a lot more openness of people considering alternative strategies and private markets. And I think it already was starting to happen where people were stepping back and looking for, okay, where is the best way to drive growth in the portfolio or income, depending on kind of what your objective is. And so I think a lot of the diversification education had happened over the last decade. And so people were already pretty diversified, I'd say, coming into this period. I think what's going to be interesting now is to see if that diversification is going to work better than it has historically. But currency was the main place that I would say clients were making adjustments, or at least considering making adjustments.
Where do you folks fall in the active versus passive debate?
I would start out by saying the active and passive is in all of our portfolios, and you want to be smart about your active risk budget, where you're spending kind of your risk, where do you think you're going to generate the most alpha, and where you're spending your fees. So we think it's a decision that you should be taking at the top level part of the portfolio in terms of fee and risk budget. But I don't think that it's one or the other, is what I would say. Similar, I would say public versus private, I don't think is one or the other. I think it's when you're developing a portfolio, you want to think about what is the best way to access this particular market or skill risk. And in certain more efficient markets, in US large cap, for example, being more passive makes sense if you want to spend your fee budget and your risk budget elsewhere. And so those are the types of trade-offs that we tend to make. And depending on the client's portfolio, depending on the types of asset classes you can allocate to, you might come up with a different answer. But we do think that active risk and that skill risk is critically important in certain asset classes. And you can think about whether it's private credit or certain types of infrastructure strategies, having a view on what types of capital projects or what types of securitized debt and the collateral that you want to have access to and the skill that goes into kind of picking those kind of securities. We think that there's value in that still, and having pure play, maybe a little bit nichier strategies in there and skill within the portfolio is going to drive value both from a beta and an alpha perspective. Others, you just want to get the beta in the portfolio. So we think there's room for both, and you should have a way for kind of thinking about the trade-off from a risk and a fee perspective.
In your role as president, have you thought about using AI on Russell's organization itself? Do you think that someday that your dashboard will mostly be AI?
So we're doing it across the organization already. So we have a lot of the stuff actually started more in, I'd say, our sales organization and with our RFP writing and things like that. There was a lot of things we were doing with AI to start out because it is more textual in terms of large language models and textual. And so things like RFPs, it was an obvious one to do. We are, like everybody in the firm, we have an objective and a goal to think through with your current day-to-day. Is there something you can do to make it more efficient and have objectives and goals for them to think through how AI can enable them? So I think beyond the investment side of things, there's a lot of things from an efficiency perspective that is going to be integrated into how we use it. We have about 550 people in India. Right now, we brought that group in just over the last 2.5 years. It's such a wealth of skill and excitement and knowledge that we're developing there. And when you have like fresh people coming into the organization amidst this technology, I don't say revolution, but technology enhancement that's happening kind of in the world, I have high expectations that we're going to think through how can we be more efficient about how we run our business using some of these AI tools. And there's some easy cases that we found where we had multiple data sources being used to source benchmarks, for example. And we were paying multiple times. We were having to clean up the data multiple times. It was just inefficient. And so we ended up saying, okay, there's got to be a better way to do this. So I think there's going to be lots of efficiencies that we're going to identify through AI. And I'd say it's front of everybody's mind. And so I think it's going to actually happen because the adoption's there. We have about 60% of our team is actively using AI every day. We want to get that up to, obviously the 80s or 90s, but that's a significant amount of the population that's actively thinking through how to use AI to make their jobs easier. Are you using it for like
practical things, or is it more of trying to look at the organization itself?
It's a mix. It's a blend. And we actually did just a couple weeks ago, we did basically a global webinar, and we had 5 different people from different parts of the organization talk about how they're using AI. And some of them were practical things to make their job easier. Others were thinking through how do we grow the business better, faster, smarter. And so there's things around sales activity where you would say there's where we're spending our time actually resulting in new business or kind of broadening out our client relationships. And so I think there's all different ways that we're using it depending on the seat that somebody's in.
I always ask folks how they handle their own media consumption. How do you know what to read, what to listen to, who to talk to?
Well, this is a place too where I'd say AI is going to be super helpful. I would say 2 things. Having, again, been in this like open architecture world for most of my career where I'm getting so much information from amazing investors and managers, I typically will have 5 to 10 given every couple of years that I'm following a little bit more closely. And it might just be because of the market environment or things that I'm more interested in, but like I self-filter like personally that way. But if Genya and I, our head of research, have been working on the different types of data sets that we're getting in, we get it in from economists and strategists, we get it in from managers. Those are probably the 2 main sources. How can we take that information in more systematically and then basically ask questions of that data? So if there's a particular issue around tariffs or around, just say, defense spending, and is it starting to shift? What are managers saying about it? We basically are aggregating all of their information that's coming to us in a way that allows us to question that data set, and they'll basically come back and say, here's the themes that we're hearing from all the managers that we invest in. It sources it for us, and it allows us to go to the particular papers, write-ups, videos that a manager is sending us that is about that topic. So we're using AI to help us filter this massive set of data that we get naturally just through our normal course of business. Again, there's certain managers that I will look at in certain things, and so I won't necessarily call out who they are. We love all our children equally, but so there's 5 or 10 that I will look at, and it'll be a mixture of like macro managers, some private market stuff, some credit stuff, and I will basically stay on top of kind of what they are thinking, different types of research that they're coming up with. I do start out the day going through Bloomberg, right? So I get up at 5:30ish, I work out and I read Bloomberg, and that's just a grounding thing for me, and it just makes me feel like I'm starting the day just aware of how the market's going to open and what's going on in Europe and Asia. But it's a constant battle. I have much less time. We talked about I commute now. I haven't commuted in ever, except for the last couple of years. And so I use that time to read longer form papers, some stuff that we write where I'm editing it, and other stuff that I'm interested in what other people are thinking. Yeah, so it varies, but it usually leans into things that I'm focused on over the next 18 to 24 months that are important to Russell and our clients. That tends to be what I'm drawn to. I want to make sure I understand other perspectives and ideas, and then think about how that might influence what we're going to do for Russell.
Has AI affected the way you look at hiring or the way maybe you're thinking about it?
We're definitely using new hiring opportunities to think about those types of skill sets that might be different than what we might have in-house. I don't know that it's a 180 change, though, versus what I might have been doing. I think having strong thinkers and people that are interested in our business, energized. There's certain people, depending on what level of career you're at, that I just think there's characteristics that will translate into strong associates over time. Like you're trying to bring in people that have more coding skills seems opposite to what AI is going to benefit from. AI, I think, is going to help people that are critical thinkers and analytical thinkers be able to prompt data sets in a way that doesn't require coders in the way that it might have historically. So if anything, I think it might have shifted us to put more of a balanced weight on skill sets and get people that are coming into the firm that are maybe a little bit more growth mindset, analytical, really thinking through how to deal with change and deal with opportunity and innovation in a pretty dynamic way. And so there's a certain, I think, characteristic that we want in people. The skill sets, I think you always want to be diversified. When I think about building my investment leadership team out, so the people that head up our portfolio management team, the research team, our CPS team, for me, I wanted to make sure they all had slightly different skill sets and backgrounds. So I don't think that's changed. I think having a diversified set of skills on your team is where a lot of the power and kind of thinking comes in. So that to me is like persisted.
So what kind of skill sets do you mean?
Well, in some cases, it's heavy quant skills in the PhDs. In other cases, it's going to be people that have more fundamental kind of background. Other people that are really process-oriented and good with process and technology and workflow, right? And really diversifying the type of problems that you're trying to solve every day and making sure you've got a good mix of people that think about it differently. I think it gets you to a better answer.
Kate El-Hillow, thank you so much for joining us and sharing your wonderful insights.
Great. Thanks so much, Joe.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.